Rick, thanks for joining us for the next Adansonia update.
Oh, Rob, always my pleasure. Thank you for having me.
Obviously, it's an interesting time around markets. Donald Trump's tariffs are making equity markets bounce and drop and bond markets bounce and drop. What's your thoughts?
Yeah, geez, Rob. I don't know how long we've got here, but interesting is one way to describe it. Look, obviously, yes, it's been a wild ride since Trump started his second term. It's funny. I was reading yesterday that after his first 100 days in office, he's caused the most damage in equity markets since the Nixon era in the 1970s. But look, long story short, um, there's a lot of emotion in the market at the moment, or the market's very much, I guess, shooting first and asking questions afterwards. And when you actually sort of sit back and take a dispassionate view on what Trump is trying to do or is doing, um, and the impact on the economy and what the markets are currently pricing, I think that there is a bit of a disconnect here. So obviously, what happened is that Trump was elected on the promise of pro-growth strategies. Obviously, talked about reducing taxes, reducing regulation. Market rallied to very high levels, unsustainably high levels. We accordingly sort of reduced our exposure in the portfolio at that time. We went to about 20% cash. He also talked about tariffs, and tariffs were a known in the market. And what he was wanting to do there, and obviously, basically onshore manufacturing on US and bring industry back to America. But I think what surprised the market is the way that he went around doing it. And look, you can basically describe it as trying to swat a fly with a sledgehammer in a china shop. So he employed a shock and awe strategy with tariff levels that were a lot higher than expected. And that freaked the market. Essentially, the risk premium in the market for U.S. assets, jumped markedly too quickly. And effectively, what you saw is that the cost of capital for U.S. assets, it changed too rapidly, and you ended up having a sell America strategy or wave sort of hit the market. So, as you mentioned, U.S. equities fell, and look, the U.S. accounts for 65% of the world's listed equity market. So it's represented in everybody's portfolios. So
Which,
that got
which is which is a high level
it is
historically.
a higher level, yeah.
Yeah.
Well, especially when you account for it. I mean, like the US is 4% of the world's population and 25% of global GDP. So you're right, 65% of the equity market in America is a high representation. And look, in saying that too, I mean, not jumping around too much. I mean, the US CEOs, in my opinion, are the best CEOs in the world, and with what they're having to face at the moment in terms of tariffs on, tariffs off policies sort of being flip-flopped around. I mean, it's very, very hard for them to do anything, with any confidence at the moment. But getting back to, essentially what happened with the markets, obviously people sold down their the US holdings just simply because of a high risk premium, high cost of capital, and sold treasuries and sold the US dollar. Well, I mean, obviously, US dollar as a function of obviously the assets being sold. You've had a disconnect. You've had obviously uh, bond uh, bond prices falling, yields rising, and the US dollar falling, and these are usually safe havens. So when markets are falling, generally you see people moving into treasuries and into the US dollar. So you've had a disconnect there. So effectively, everything in the US has fallen, and it's just simply been by an outflow of capital. Now, we believe that this is a short-term phenomena, and the US dollar will basically, regain traction. So there's this talk that the US dollar, is potentially no longer, the global reserve currency. We just don't see that as being viable. That, a lot of money's gone into the euro or Swiss franc. I mean, the euro isn't old enough. It's fragmented. It's still got the potential, basically, coming apart. In the end, still 60 to 80% of all transactions globally are US dollar based. So as I said, this is just a short-term phenomenon. And look, with what we've seen at the moment, the market is basically fearing that the imposition of these tariffs are going to basically be highly inflationary for the U.S. consumer. Is going to basically slow growth. Raise the prospects of stagflation and push the U.S. into recession, along with other countries. Potentially globally. And in the paper which we've done recently, which you guys have, when you actually do the maths, and just talking specifically about the risk of stagflation and the impact of inflation, I mean, the fact of the matter is, the US has a trade deficit of around $1 trillion, and when you take China out of that equation, the deficit of the rest of the world is around 700 billion. But then, if you look at US imports, ex China, which are around 4 trillion, they're less than 20% of consumption, because essentially consumption makes up about, sorry for jumping around all of these numbers, consumption is about 70% of US GDP. GDP is 30 trillion. It's about 21 trillion for consumption. 4 trillion is a percentage of 21, is under 20%. So only about 20% of imports, imports only account for about 20% of US consumption. So when you take into account, or when you wash that through the numbers, that 80% of what's being consumed within the US doesn't have tariffs. And then if you look at the assumption that also that at the end of all of this is not where the tariffs start, but where they finish, and that if we largely end up with a 10% base case tariff for most of the countries excluding China, obviously there'll be some tariffs which will be higher, where trade deficits can't be closed, or there's still strong ties to China, like with Vietnam or Thailand, and then a stronger dollar, and the fact that corporates will basically absorb some of the margin loss to get access to the world's largest consumer base. The impact on inflation within the US, we believe, will be less than 1%, and that basically gives the Reserve Bank plenty of room to stimulate if they have to, if growth does slow. And then obviously what's happening, the US consumer is already anticipating higher prices. 70% of consumption in the US is services. So obviously less being spent on services, deflationary, that's also going to basically help keep inflation numbers down. So look, within the paper, you'll read that when you actually look at the maths, the prospect for stagflation, we think is far overthought, or not overthought, but overestimated. And essentially, if we do get a slowdown in growth, worst case scenario, a shallow recession, that the Reserve Bank or the Fed has the ability to basically to act without essentially worrying about fueling inflationary pressures that the market's believing that will basically stop them from doing so. So look, that's just our thought in the paper, and as I said, and also there are other sort of themes in play, Rob, where we believe that the US is also very much worried, or Trump is also very much worried about the structural decline of manufacturing within the US. Manufacturing within the US around the 1980s was about 25% of GDP, so they've fallen to under 10. So there's also a play here where America is trying to basically ring fence China, and essentially, I guess, try and bring China's trading partners over to America, through basically tariff deals, where essentially tariff deals are being sweetened at the moment by obviously the US having a far lower corporate tax rate than, for instance, the EU, 15 to 25%, and allowing a write-off of capital in the first year to onshore on the US, and also basically the ability to provide energy and military support to countries that need it, which are being under threat within China, especially within the Indo-Pacific. So you're seeing that a lot of the higher tariffs were basically being levied in the Indo-Pacific region to bring these people to the table quickly to get these deals done. Obviously, and that's also for the rest of the world. The Treasury Secretary Bessent is sort of saying they've got 70 people talking to them at the moment, 70 countries talking to them at the moment. So hopefully, just to get this behind us, But as I say, I mean, with China basically being more aggressive, towards the likes of Japan, Taiwan, and the Philippines. A deal where the US basically offers military support, as well as cheaper energy. Can basically help get the deals done with these countries to sort of weaken China, both financially and in a military sense. And the fact is that a lot of people are sort of saying that China, the US is being the bully at the moment. When you look at the history though of China and the way it's acted, and essentially the level of state subsidies, and other sort of anti-competitive measures in place at the moment in China, including tariffs to prevent free and fair trade with the US and other countries. It's really the kettle calling the pot black. And also, we've even seen it ourselves. China basically put huge tariffs on Australian exports of wine and lobsters and agricultural goods. Essentially when the Morrison government criticized China, or blamed China for COVID. It took a long time for those countries, or for those companies, I should say, to sort of manage to find other markets for their goods. So look, China became a member of the WTO in 2001, and they certainly haven't sort of adhered to the rules that they were supposed to. So we sort of see that there are many things at play at the moment, many different sub themes, and many different strategies which are basically playing out, and it's all sort of related to tariffs and the negotiation of these tariffs over the next 90 or less days.
So, in regards to, obviously that's more of a look at the macro, but ultimately with the investments or the businesses that you own,
Yep.
you're also more focused, I would say, on the micro, like what's going to impact upon these companies. Agreed?
Oh, for sure, for sure. So look, as I said, it's look, a lot of the companies we've invested in are multinational, but they're the US dollar, they're US listed. But yeah, as I said, look, these companies are lobbying, and are basically making changes. They have to, and we're actually seeing a lot of companies reacting, in line with what was wanted in terms of pledging more investment onshore, in the US, and it makes sense. If you've got the US being 25% of global consumption, it makes sense to basically bring your production closer to the States. The question is obviously, there are some industries like auto where you can onshore in the US, because obviously it's all about having labor costs that are competitive or similar, and obviously you've got AI, which will basically help reduce labor costs, robotics that'll help to reduce our labor costs over time. But then you've got countries like Vietnam, etc., like that, where it's just cheap labor, and they make commoditized goods, and it doesn't make any sense for those industries to be. They can't compete to be onshore in the US just by the sheer fact of the labor costs being markedly high. So as I said, it's definitely a juggle. But generally with what we have in the portfolio, I have to say that the worst impacted by all of this is Porsche. In the sense that while automakers including VW and Audi and Volvo, and Honda is actually basically turning around from producing its Civic from Mexico now to Indiana, and Kia, I think, as well. They're all basically pledging investment on the on US soil. The fact is that Porsche is only makes about 70,000 cars a year, and look, at the moment we are thinking that they might generate some of their, or build some of their SUVs in Texas or on US soil for the consumers. But at the moment, there's been no clear message from Porsche that they will do that. So again, they're probably the most impacted that we have within the portfolio. Share price is definitely definitely sort of unfortunately showing this, but to the point where it's oversold in our opinion. And again, it depends what happens. So the EU at the moment has 20% tariffs, which will probably likely stay around that level, Rob, because that's the level of the VAT that's in Europe at the moment. I think from 19% in Germany, 20% France, 22% in Italy. Also, very very hard for the EU to make a homogeneous or a one size fits all deal with the US. In that you've got some countries within the EU like Spain that don't really trade with the US at all, whereas others do, like France and Germany. So it's really going to come down, we think on a company by company level, with what happens there. But interesting thing is that we looked at Porsche as an example, in terms of just the impact of the tariffs and the hypocrisy that's currently in the market around the shock and horror of the US looking to employ tariffs to the tune of 10%, for argument's sake. And the silly thing is that at the moment, a Porsche is still cheaper in New York, after the tariffs, and including state taxes in New York. That's where we sort of looked around, I think 7.25%, than it is in Germany, in the factory base model 911 Carrera. And obviously a lot cheaper than in China, and obviously last is Australia. It's because we have GST, VAT, as I mentioned before. In China, what you call luxury car taxes in Australia. The US at the moment doesn't impose a consumer tax on US consumers. So despite all of this and the shock and horror that the US consumer are going to have to pay more, it's still cheaper to buy a Porsche in America than it is in Germany, let alone in Australia. So there's a lot of hypocrisy at the moment, sort of flying around the markets. And as I said, nobody likes change and uncertainty, and this is sort of what we're reacting to. But when you actually look at the numbers, and again, as I said, Australia basically lives with a 10% GST. And at the moment, the tariffs within the US, if they do basically normalize to a base level of 10%, give or take a little bit, that's only on imported goods, which I mentioned is only is less than 20% of consumption within the US at the moment. So when you take the emotion out of it, and you just look at the numbers, it's not that drastic, and it's not the end of the world as such, in terms of what you're sort of reading in the media and what's and the reactions that we've sort of seen in the market, where you had the US market fall more than 10% in 2 trading days, once these tariffs were basically released. So we've had a bit of a bounce, obviously, off lows, but at the moment, I think the market is very much in a holding pattern, just to sort of see how these tariff deals basically pan out over the next few weeks. And obviously we're in reporting season now, and there's obviously a lot of attention on the outlook statements of from companies in terms of the impact of these tariffs on earnings going forward.
Yeah, no, excellent. And just to finish off, Rick, performance. Like, obviously, one of the interesting things about the strategy is how you've outperformed your benchmark over a long period of time. How's the last little period impacted upon the strategy?
Yeah, Rob, I would like to say that near term, it's also been the case nearer term. Over the last 3 months of the last quarter, we've underperformed the market by just over 1%. The portfolio is down 3.81% versus the MSCI World Net Index in AU dollars 2.72. So look a little disappointing. In saying that, we did basically preempt a lot of this, and we went to 20% cash. The problem is that we've got a lot of US growth companies, and they're the ones which are being hit hardest. In saying that, we're very comfortable with the holdings and the valuations presently in the portfolio, and when we do see a bounce back, they're the ones which are rallying the hardest. So look, a little bit of a near-term disappointment, but we're still very comfortable with the portfolio. Looking to deploy some of the cash around these levels, or a little bit lower. We sort of, as I said, it's hard to pick a bottom at the moment, although we sort of saw the S&P 500 dip under 5,000, which is sort of probably where we'd be more comfortable, bottom fishing selectively. Like we've got target prices for companies. Longer term though, we're still doing very well. We're running at 15.7% per annum since inception, which is a bit over 6 years ago now, versus the market at 14.5. So we're outperforming. But as you say, the portfolio has taken. Some of the stocks in the portfolio have been hit, harder than what we would have expected. Obviously, we've got some AI exposure, which is a dirty word at the moment. So as I said, 20% cash or 17% at the moment now. Didn't quite give us the shield that we wanted. But as I said, we think that this is. The upshot of all of this is that we do not believe that we're going to be in a very, very protracted trade war with the rest of the globe.
I think that the reason they're going hard is they want to get all the pain out of the way. You mentioned that
exactly, rip a band-aid off fast.
The lowest share market in the first 100 days. To be frank, I don't think he'll care.
Exactly.
But the share market 100 days going into the next election, they'll care a lot.
No, exactly. And look. Also, I mean, what happened is that the interesting thing too is that we have to recognize that this is all man-made. And one person that largely sort of orchestrated this can unwind this very, very quickly. And the collapse that we saw in the share price and the spike in the VIX, was as bad as what we saw at the start of COVID. A global pandemic where essentially, we didn't know how much of the world was going to basically die because of this virus. So I mean, it's the relativities are really quite stark. And also, we saw the VIX go from 2021 to well over 50. And every time the VIX has gone over 50, essentially the share market has ended up higher, on a 12-month view. So look, again, there's a bit to digest at the moment. People are sitting on the hands, but in the end, we will digest this, wash through this, and move forward. And we quite, we're comfortable with the portfolio, and we'll, it's just a case of writing it out now. And the problem is that, as I mentioned, the way that the policy has been enacted has been confusing at times. Tariffs on, tariffs off. So there's been a lot of toing and froing, zigzagging, and there's been a confusion. So as I said, it's what we do not do is we do not react to noise. So that's the worst thing you can do. So look, we've done a lot of work, a lot of navel gazing. We've tried to basically nut out what this actually means, what the strategy is, how it will unfold. And we're playing the longer term game here, and hopefully we've called it correctly.
Yep. No, thanks, Rick. And equity markets, no matter what form you invest in them, they don't do it in a straight line. So it's you've got to be there for the ups and the downs, and
exactly
it's on the brochure. So it's what you signed up for. So you just stick with it.
Still the best game in town, Rob. Still the best game in town.
Yep. So what I'll do is also I'll distribute that paper that you guys did on those tariffs, because it was a great paper.
Thank you very much.
Read it myself. It makes for good reading.
Appreciate it. Thank you very much, Rob. And thank you again for your time. Always a pleasure to speak.
No dramas, Rick. We'll keep up the good work and we'll talk next time.
Thanks, Rob.